Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into the latest financial report from Adeia Inc. And let me tell you, this report is like a magician's act, making a lot of profit while still keeping the debt pretty high. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below so that you can tell me how wrong I am after this video. We are talking about Adeia's 10Q form, which is the quarterly report of their financial performance. Adeia is one of the biggest companies that licenses intellectual property or IP, especially for media and semiconductors. Think of it like they own the rights to certain technologies and get paid when other companies use them. Let's get into the numbers. This report covers the first 3 months of 2025. Revenue increased to $87.07 million. That's about $4 million more than same period last year. Operating income, or how much money they're making before considering interest and taxes, also jumped to $22.28 million from $19.42 million. That's pretty good. Net income, or the actual profit after all expenses, is where things get interesting. It's skyrocketed to $11.08 million last year. Because of that, earnings per share also went up. Where is that money coming from? The increase in revenue is attributed to new multi-year license agreements. Now, not all revenue is the same. We have to take a look at recurring versus non-recurring revenue. Recurring revenue is the stable stuff like ongoing subscription fees, and it increased slightly. Non-recurring revenue, which is from one-time deals, that number jumped significantly. Now let's talk about expenses. A big one for Adeia is amortization expense, which is how they account for the decrease in value of their intangible assets, things like patents. That expense decreased this year, which helps the bottom line. One expense that still hurts them is interest. Although that expense decreased compared to the same time last year, they are still paying a lot to service that debt. Moving on to the cash flow, and this is where we see more of the details. Cash flow from operating activities, which is how much money the actual business brings in, was $57.02 million they made last year. Why is it lower? It's a combination of factors, including changes in accounts receivable and other assets. Looking at the balance sheet, the amount of long-term debt has also decreased. They are paying it down. One way they use that money is by buying back their own stock. When a company buys back its stock, it reduces the number of shares available, and each remaining share is then worth more. They are not just spending on themselves, they're still doing financing activities too. Although still negative is quite high this time because of debt payoff and stock repurchases, they are using more money than they are earning with financing. The company's cash and cash equivalents increased, always a good sign. The company has a few properties and facilities that they lease, with a weighted average of 7 years for the end of the lease. They spend around $500,000 a quarter on these facilities. Now, let's talk about potential risks. You see, there is a note about commitments and contingencies, which sounds like they have a few risks they need to report. That includes legal proceedings. Adeia, like many IP companies, is often in court defending its patents as a company that depends on patents. It makes sense that they have to do this. Their patent battle with Bell Canada is finally starting to trial this month. Adeia also got into it with Disney over some of their patents. Some of those cases are in the US, others in Europe, and even Brazil. That's a lot of legal activity. Now, the company states that there are no material changes to the risk factors since their last annual report. Long-term obligations include money they might owe because they guaranteed a deal between another company and someone else. That means if that company cannot pay, Adeia needs to guarantee the performance. It should be noted the company operates under one reportable segment, IP licensing, so that means that they only do one thing. Most of their revenue comes from US. They are also paying dividends from their own common stock as well. So they are sharing profits. Although they already repurchased a lot of common stocks, they still have around $170 million to keep buying if they want. It should be noted that some of their most important expenses are related to personnel, patenting, and litigation. But alright, so that's the financial report. What does it all mean? Adeia had a good quarter, showing increased revenues and profits. The balance sheet is up, but still not enough in comparison to the debt of the company. But their business depends on enforcing intellectual property, so the costs and effort of this will remain as is and is a business and opportunity risk. The company is a good one. Their stock has been pretty consistent so far. If they manage to start having more cash and less debt, it would be a solid company, one that can generate good profits for years. What do you think about Adeia? Let me know your thoughts in the comments below, and don't forget to like and subscribe for more quick summaries. If you want to tell us we're wrong, make sure to join our Discord. The link is in the video description. Thanks for watching.